How banks really decide on your car loan. Why a high credit score doesn't guarantee a low rate anymore. The secret risk score your car has that could deny your loan. How your zip code can affect your interest rate without anyone saying a word. Why putting more money down is the strongest tool you have. What happens after you drive off the lot? The bank is still watching. Section 1. The three-part test for every loan. Banks do not just look at your credit score. They judge every loan application on three main things: the person borrowing, the vehicle being bought, and the money involved in the deal. Each part gets a risk rating. Your final approval depends on the combined score of all three. Section 2. Judging the person, your financial profile, your credit and job history. Banks now deeply check your credit report. They look for real credit history, not just a score. They verify your job and income directly with your bank or employer using secure databases. You typically need 6 to 8 months at your current job for larger loans. They also confirm where you live by checking utility bills in your name. The impact of where you live. Banks use your zip code to assess risk. They have data on payment histories for entire neighborhoods. This lets them estimate risk based on location without using illegal factors like race. Living in a high-risk area can lead to a higher interest rate or denial. Section 3. Judging the vehicle, its risk score. Every car model has a risk rating. Affordable, reliable cars have the lowest risk. Luxury and exotic cars have very high risk scores. Banks want your vehicle choice to match your credit history and income. Jumping from a cheap car to a very expensive one often leads to denial. Some specific models, like older Dodge Chargers or Kias, are flagged as high risk for repossession or theft. Section 4. Judging the deal, the money terms. The importance of a down payment. A strong down payment, 10 to 20%, is the best way to lower the overall risk of the deal. It shows the bank you are serious and have your own money at risk. If your personal or vehicle risk scores are high, a larger down payment can be the only way to get approved. How banks charge the dealer. If the bank thinks a deal is risky, they charge the dealership a fee to fund the loan. The dealership often passes this cost to you, either by raising the car's price or asking for more money down. A good finance manager will tell you which cars you qualify for to avoid these hidden fees. Section 5. Life after approval, staying in good standing. The bank continues to monitor you after the sale. They may check to ensure you still have full insurance on the car and that you are not using it for prohibited commercial purposes, like ride sharing. Being honest with the bank if you move or have trouble paying builds a good internal customer score, which helps you get future loans. Final summary. Getting a car loan approved depends on three risk scores: yours, the car's, and the deal's. Build real credit history, verify your income, and be aware of how your address affects rates. Choose a car that matches your financial profile. Always provide a significant down payment to strengthen your application. After purchase, maintain good communication with the lender to build trust for future borrowing.